Hi everyone, I'm Artur and welcome to Reimagine 2020. Today I have with me Antonio Juliano from dYdX, a decentralized order book exchange with margin trading and derivatives. Welcome, Antonio.
Hey, thanks for having me.
Great to have you here. Why don't we jump right in? How did you get into crypto and what is dYdX?
Yeah, absolutely. So I'll start with how I got into crypto, maybe just really briefly. So I got into crypto back in 2015, where I worked as a software engineer at Coinbase. I was fairly early on there, but I got to Coinbase pretty differently than the way most people got there. I didn't really know anything about Bitcoin or cryptocurrency before I got to Coinbase. But while I was there were just a lot of the top people in the space at Coinbase at that time. So I got a really firsthand seat to learning from a lot of them, getting really excited about the space. And that just gave me a lot of conviction long term, and made me really excited about the potential for the types of things you could build just going forward in the blockchain space. And I think the thing that really got me excited was right around the time I was at Coinbase was when Ethereum came out, and really got a front row seat, like I was saying, to seeing the really exciting new things that you could build on this new paradigm of computing, where kind of for the first time you can write these programs that will execute totally autonomously and totally deterministically in a decentralized way. And it seemed to me at that time, I didn't know what exactly I was going to build or what exactly would be really big based off of that, but it just kind of made sense to me that given this new paradigm of computing, there would be like really big, exciting things to build on it at some point. And a couple of years later, that really was the motivating factor behind starting dYdX. dYdX, as you mentioned, is one of the leading decentralized exchanges, and we're a little bit different than most decentralized exchanges in that we focus on, I would say, more advanced financial products. So things like margin trading, things like perpetual contracts, just ways you can kind of get leverage, which I'll talk about kind of what that means later, and just go long or go short on a variety of different crypto assets.
Right, right. I mean, great journey so far. Congratulations. Maybe you could just explain. So, like, decentralized exchanges this year, definitely they've been, they've kind of arguably they've finally gotten so much of the attention that people have been, expecting for years.
Mm-hmm.
dYdX is a little bit different because you guys are an order book exchange, right? How has this year kind of been? What has this year been like for you in terms of traction and traffic generally?
Yeah, absolutely. So that's a good point. We're an order book based decentralized exchange. I'd say there are, very high level two different types of decentralized exchanges, as probably a lot of you know. On the one hand, there's automated market makers. So these are things like Uniswap, like Sushi Swap, Curve, stuff like that. And then on the other hand, there's order book based exchanges. So this is like dYdX, 0x to a certain extent, things like that. And certainly the thing that's really taken off this year has been more on the like automated market maker class. And I think the reason that that's really taken off in a huge way is that automated market makers, kind of the thing that they're really good for is just supporting like the really long tail of assets that people might want to trade. Like it's really easy to spin up a Uniswap market, really easy to start building liquidity on it. So kind of for like the 100 to like 1,000, by volume market cap, of the tokens, like Uniswap is like great for those types of things. Kind of on the order book style, the big advantage there is that it's a lot easier to build liquidity on these markets. So that's kind of why we focus on those markets, especially for some of these more advanced products that require higher amounts of liquidity, things again like margin trading and derivatives. I'd say the past year for us has also been really good, not quite like Uniswap good, but we've gone from like, I think we were doing about 500K in USD of daily volume back in January, and now we're up to about $10 million a day or so in average daily volume. So it's been like a
Wow.
20x increase for us as well. Not quite the 1,000x increase, but I think we're getting there. I think we have a lot of exciting things in the pipeline that I'll talk about in just a little bit. I think maybe taking a little bit of a step back and thinking about how I think the DeFi space is likely to evolve over time. I think just the DeFi space is kind of like mirroring the evolution that we saw in the centralized exchange space, but it's just a little bit behind. In centralized exchanges, just kind of the evolution of products that we saw were like first like spot trading, just normal buy selling, got really big on exchanges like Coinbase, Kraken, things like that, Bitfinex to a certain extent. And then margin trading got really big after that on Bitfinex. And then just what's happened in kind of the centralized exchange world is within the past year, centralized derivatives have really exploded in volume. And I think that that kind of evolution in the DeFi space is likely to happen as well, where we're kind of seeing just like the kind of birth in a big way of just like the, simple kind of spot trading products like Uniswap and a bunch of other great ones that are out there. But I think along the road, maybe in the next year or so, we'll see a really big explosion in kind of more advanced types of financial products like derivatives.
Right, right. And I guess like the like some of the reasons why Uniswap has taken off is, like you said, that it's just so easy to kind of to bootstrap a very the very first market for a token, right? But but then at the same time, once the market has been there for quite a while, then or for some time already, and it gets into these like growing pains essentially, where like the liquidity is either like hits like a glass ceiling, and this is where kind of like experts say that like order books become the kind of the necessary thing to bring it to the next level. How have you guys kind of or how have you seen these sort of the developments with with the kind of product market fit of these AMM sort of like models? Has it sort of made dYdX also think that what if we could we also adopt like this starting point type of mechanism for a market, and then also offer like the to carry forward with the order book technology?
Yeah, I think that's a great question. It's definitely something that we're paying really close attention to. I'd say we don't have any plans to like build an automated market maker or anything like that at this point. But we do have plans to be able to launch like a bunch of new markets a lot faster than we have in the past. And I'll talk about kind of what the plan is there. But the plan is really to stick with kind of this order book based model. And again, it just makes a lot of sense, especially for more advanced products, where people are trading with leverage. Trading with leverage just means there's oftentimes a lot bigger trades, a lot more liquidity that's required to kind of make sure that these types of products are healthy, that kind of, if the price is going way up or way down, that there's enough liquidity to do liquidations, things like that, just things that are really core to just kind of the overall health of the system. And that's really the big reason why we've been focused on the order book based model. One pretty interesting statistic about dYdX is I think, I haven't looked at it super recently, but our average trade size on dYdX is about $15,000. Which is way, way higher than most exchanges have. And kind of the reason that it's so high on dYdX is just a combination of, first of all, like the gas prices. And then second of all, that dYdX is really focused, like I've been saying, on just kind of these more advanced financial products, which are oftentimes tailored to, more of the like whale type users, not always like super big whales, like it's available to everybody, but I'd say like, more sophisticated types of traders are the types of traders that gravitate towards these products, and they oftentimes are trading with larger amounts. So kind of this order book based model is really important for us to be able to do that. In addition to just having an order book based model, dYdX is known as what's called a hybrid exchange. And that basically means there are some decentralized components to dYdX, and then there are some centralized components to dYdX. The decentralized components are obviously the smart contracts, which just give us all of the kind of self-custody, all the trustlessness of the system. But the components that we have in a centralized way are basically the order book and then the matching engine. And this just allows us to have way more performant trading, especially for market makers, which again translates to way higher liquidity for our end users. So that's something that we've built out. It's actually, the evolution of dYdX. We used to basically plug into other third-party decentralized exchanges to kind of do the trading. And then we found a lot of issues with those approaches in terms of lack of liquidity. If any of you guys have ever used a decentralized exchange, you may have run into things like your trades reverting or things like that as you're trying to place trades. dYdX doesn't have any of those problems because we have this hybrid model where we can get to like trade finality really quickly with the central matching.
Right, right. I think the first decentralized exchange I used was EtherDelta in 2017, 2018. And I would say the user experience has come a long way since then.
Yeah, absolutely.
What is the you mentioned that dYdX is mainly used by slightly more sophisticated traders. What is the main kind of the most popular either like trading pair or a trading product that you see most used?
Yeah, absolutely. So we have three main trading products right now. So the first is spot trading, just normal like buying and selling that you'll find on pretty much every exchange. We have that too. And then we have margin trading. And then most recently, we've launched perpetual contracts, which are a type of derivative contract. The most popular trading product right now in pair is still the margin trading product, and specifically on the ETH to DAI and then ETH USDC pairs. Those are probably the biggest pairs that we have right now. But also the perpetual contracts have been growing a lot quite recently. We just launched that product a bit more recently.
Right. And what do you think, what in your experience are kind of like the biggest user like friction points, or what do you sort of, what do you wish you could kind of solve when it comes to, you know, bringing in more centralized exchange traders to a decentralized platform?
Yeah, that's a great question. And maybe this is a good segue actually to some of the scalability stuff too, because we're actually solving a
Yes,
lot of this
please.
with the scalability stuff. But I'd say the biggest UX problems that we have right now are fairly similar to what probably, you know, a lot of other decentralized exchanges would have as their biggest pain points. So things like needing to wait for a transaction to confirm before your trade goes through. So it's kind of like whenever you're trading on dYdX, very similar to like any other decentralized exchange. It's like you make a trade and then there's like spinners on your balances while the transaction is mining, and you have to wait like 30 seconds up to a minute for your trade to confirm and for your balances to update. So that's a pretty big drawback in terms of what users are used to from centralized exchanges, where it's like you make a trade and then immediately your balances update, immediately you can withdraw all of that. We're actually going to be fixing this one pretty much fully with our Starkware Layer 2 integration, which we can talk a lot more about later, and I'll come back to. I'd say the second biggest probably like UX challenge is just like wallet integrations. And I think this has come a long way within the past year or so. But still, there's a lot of pain points with just the wallet space overall being like, you know, relatively immature, and just like wallets being kind of buggy. A lot of times they'll have issues like connecting to our application or things like that. They have issues like surfacing like the appropriate information to users. Like basically the way dYdX works is that when you're trading on dYdX, you're just basically cryptographically signing orders with your wallet. But the things that you're signing in your wallets are basically, you'll see like the amount, which is the real amount, but it's like encoded as a hexadecimal string. So you'll see like, you know, maker amounts like 0x like ABCD, and you're like, what the heck is this? So I think that's something we want to continue to tackle over the long term, is just being able to surface, you know, basically be more transparent in users' wallets and have the wallet integrations be a lot smoother. And we're working with a number of different like wallet providers to be able to do that long term, which I'm excited about. I'd say like the third biggest like pain point to trading on dYdX as compared to a centralized exchange, specifically for our products, is kind of the lack of high leverage that people like to use on like centralized exchanges. So the like perpetual contracts are basically where you see the like 100x leverages of the world that like a BitMEX or like a Binance might offer. On dYdX, our maximum leverage that we offer right now is only 10x. And the reason that we can only offer yeah, absolutely. Like definitely do your research before you're kind of trading with any leverage, disclaimer. But definitely, you know, there is a use case, and it does actually drive a lot of volume for kind of the higher amounts of leverage, because leverage for an exchange basically means that people are just trading with some multiple of the capital that they have. So it means like a lot of volume going through the exchange. And consequently, that means a lot more liquidity and just an overall better product for people if you're able to offer this higher leverage. But the reason, as we're getting to, that we're not able to offer the higher leverage is just because of kind of the performance of price oracles. And what price oracles are, they're basically just smart contracts that live on Ethereum that will tell you what the price of given assets are. Like if your smart contract wants to know what is the price of Ethereum right now, you need to integrate with an oracle to be able to do that. And just current oracles on Ethereum aren't really that performant, just in terms of like there's really high latency whenever they're updating. So it's like, say the price of Ethereum drops 10%. the question you might want to ask if you're running a decentralized exchange on leverage is, how long is it going to take for that price drop to be reflected in the price oracles? And right now it's kind of on the order of like 5 to 10, sometimes up to 15 minutes. So if you're running one of these leveraged exchanges, you kind of have to think about, well, okay, what's kind of the maximum amount that we think the assets that we're supporting could drop within this like 5 or 10 or however long it is time period. And we're addressing this one too, actually, in a really big way with our Starkware integration, which I can talk about soon.
Yes, please. Let's go straight into that. So so I think you guys are actually one of the few companies that is actively not just looking at level 2 solutions, but that is actually working on building it out. Can you tell me a bit more about that? So you guys have chosen Starkware. What is Starkware, and why was it the best fit for dYdX?
Yeah, absolutely. And just kind of address your first point there. I think it's basically like everybody in the space is like thinking about scalability, and we were for a long time as well. But we're really actively building it right now. Actually, right before I got in this interview, I was just coding up a bunch of stuff for our backend, kind of for our Starkware integration. So it's not in the research phase or anything like that. We know exactly what we're going to build. There's no unsolved questions. And now it's just a question of spending the next few months building it out alongside Starkware. And then to answer your second question, like what is Starkware, and then why did we choose them kind of as the natural partner for us on scalability? So Starkware specializes in basically zero knowledge proofs, if you've heard of that, and specifically Stark-based proofs, which are kind of a more novel or like more advanced version of a zero knowledge proof. And they basically use these zero knowledge proofs to achieve scalability. And the really high level way it works from a technical perspective is you can basically take a bunch of data, which in our case would be a bunch of, say, trades we want to execute. Say there are like 1,000 trades that we want to execute on dYdX. The way that works right now on dYdX is for every one of those 1,000 trades, we have to send one transaction to the blockchain and pay gas fees on it and everything like that. And that's just, as you can imagine, extremely expensive. But with Starkware, what you can do is you can take these 1,000 trades, and then you can basically do magical math on it, which is kind of this zero knowledge, like Stark-based proof. And you can turn these 1,000 trades into this constant sized small data object. And by constant sized, what that means is that it doesn't matter how many trades you have. You could have 1,000, you could have 10,000, you could have potentially more. And it would the kind of the size of the proof that kind of proves that all of these trades happened is still always the same size, which is really cool, because then you can basically just put this constant size proof, which proves that these 10 or 100,000, even more trades all happened. And then you send this to the smart contract on Ethereum. And it's like, that now no longer do kind of our gas costs vary based on how many trades that we're executing. It's always kind of this constant size data object that we're just putting it in like every once in a while. So that's where the scalability comes from. And that's kind of the magic that Starkware provides. The way we're integrating with them is we're basically just taking our hybrid like matching system, our like central matching system that we have right now, which right now the central matching system, what it does is, like I was saying before, it just sends one Ethereum transaction for every single trade. And now instead what we're going to do instead of that is we'll send just an API request to Starkware system that will basically ask them to include all of these transactions, these trades that we want to send into their zero knowledge proof. So that will just get us like massive amounts of gas savings, or estimate like at least 100x in terms of gas savings right now. So basically it's like us, like centralized company like dYdX, who are running this like matching engine right now, are actually paying all of these gas fees. It's not so much like users send their own trade transactions on dYdX. It's like we send trade transactions on users' behalf. But as you could imagine, this has become a really massive expense for us. And it's kind of forced us to pass on, especially recently, like the gas costs directly onto our users. And it's pretty madness right now. A lot of times recently, on the days where there's been like the Uniswap, like Unitoken kind of coming out and things like that, it's literally cost us like over $100 per trade in gas fees to execute these trades, which is like, who's going to trade on an exchange where you have to pay $100 in fees for every single trade that you make? Like I wouldn't, like probably not that many of our users would either. And that's kind of the main problem that we're trying to fix here, is
Mm-hmm.
that just like after we have this Starkware integration, like the gas fees should go way, way down. But we're also just kind of, that's not the only reason like why we're integrating with Starkware. We're getting a lot of other like really important benefits off of this build out as well. And I can kind of go through what those are in turn. So the first is like a little financially technical, but it's actually really important. The way dYdX works right now is with what's called isolated margining. Margining basically just means when you're trading on margin or you're trading on a perpetual contract, it's just like the amount of collateral that you put down to basically be able to trade in the system. And isolated just means that all of the products on dYdX, so like we have an Ethereum perpetual and a Bitcoin perpetual and a Link perpetual right now, all of them are margined separately. So that means if you want to say trade on both the Bitcoin perpetual and the ETH perpetual, you have to put down collateral separately. You have to put down like say, 100 USDC like into the Bitcoin perpetual and then 100 USDC into like the Link perpetual. And these are just like totally separate accounts that you have. What we're going to build with the Starkware integration is what's called cross margining. What cross margining is it sounds complicated, but all it is just using the same pool of collateral to collateralize all of the products that you might want to trade on. So now it's like, instead of having to put down 100 USDC twice, because you want to trade on these two products on dYdX, you only have to put it down once, and then that'll collateralize like all the positions that you might want to take on all these various perpetual contracts. So that's really nice for users because it just makes it a lot more capital efficient. So you overall just need less collateral and less capital to trade on dYdX, which is really nice. But it's especially impactful for market makers, actually. So basically the way market makers work is they're just kind of trading on dYdX, always offering just quotes to like buy or sell the dYdX perpetual contracts at various prices. But the way, market makers have to use collateral too. So it's like if a market maker wants to say, start quoting on like the Bitcoin contract and the Link contract, again, just like the users, they'll have to put up collateral separately for each of those contracts. And this just becomes really, really capital intensive for a market maker. If you want to say have a bunch of trading markets on dYdX, because you'll have to collateralize like all of those independently. And it's just like linearly expensive to become a market maker on dYdX in that case. And this is like the fundamental reason why we at dYdX like haven't launched that many markets, even though we've seen a lot of, like we were talking about before, a lot of the trading activity that's really spiked recently has come from a lot of these new markets. So the main way we want to capture a lot of that is by adding new markets. And the way we're going to do it is just by this cross margining. So once we have cross margining, it's like the market makers, just like everybody else, can put up one pool of capital, and then they can just start quoting on like every single product that they might want to trade on. So we're anticipating after launching the Starkware build out that will kind of add at least like 20 to 40 new markets in kind of the year following that, up from like the 3 or 4 that we have now. So it's going to make a huge difference. Then kind of after that, the kind of like I mentioned before. Oh, sorry, go ahead.
No, good.
Okay, sorry, like I was kind of alluded to before, just there's going to be a lot of really important like user experience changes that are coming out of the Starkware build out. The first is just going to be, truly instant trading, where, the trading experience on dYdX is literally going to feel like trading on a centralized exchange. It'll still be totally trustless and all of that. But it's like you'll make a trade, your balances will update immediately. You'll be able to withdraw the funds immediately. And this is just from all the speed that we kind of get through the Starkware integration. And then kind of the last, but like also really important benefit that we get off of it is just much more performant price oracles. So like very high level, what we're doing is basically putting the price oracle updates on layer 2 or into the Starkware system. And we're still using actually the exact same kind of network of oracle reporters. So it still has the exact same level of decentralization for the oracles, but you just get way higher performance by kind of putting them on this layer 2 Starkware system. And that means we're going to be able to offer like much higher leverage as well. So overall, I think the dYdX product is going to be vastly improved after we do all of the Starkware build out. And we have a pretty advanced timeline for launching this as well, even though this is going to be one of the most complicated apps that's ever been built on layer 2, period. We're going to build this alongside Starkware in just a couple months. So we're aiming to launch in about 3 months from now.
Wow. So, I mean, that is amazing. So, so as you said, so the kind of the benefits of the level 2 in your case will be around 100x cost reductions in terms of gas and higher leverage and basically incredible speed improvements as well.
Yeah,
That's
absolutely. And a bunch of more assets as well. Yeah.
And more markets, and I mean, it seems like a win-win all around. And tell me, when did you decide to start building on Starkware?
Yeah, so we decided about, I guess, like a month and a half or 2 months ago now. We've been building alongside them for pretty much that entire time. I guess maybe just talking about our decision process, or like why did we pick Starkware over other potential scalability solutions. I'd say just the overall highest priority reason that we chose Starkware was just that they're much more production ready for kind of a production trading system than pretty much any other scalability solution that we considered. They're already up and running in production with a couple other decentralized exchanges. So they're running with this exchange called Diversify right now, which just offers buy-sell spot trading. So it's like they're building something a little bit custom for us on kind of the margin trading and then the perpetual contract side. But they have already a history of just running these systems up in production. Again, it's not like a research project. It's not like there are any open questions. It's like, it was just a matter of us partnering with them. And it's like, okay, we know what we need to build. We're going to spend 3 or 4 months building this, and then it's going to be done. And we know it's going to be done, and we know it's going to work. Whereas a lot of the other projects or maybe technologies that we evaluated were much more in the research phase, I would say. Overall, not all of them, but I would say that was kind of the overall TLDR. So the main things we considered were obviously Starkware. Then we considered what's known as general purpose optimistic rollup systems. If you've heard of optimistic rollup systems, basically the way those work is that they're optimistic. So that basically just means an operator can kind of put through any state change or any amounts of trades that they might want to, and there's no checks at all. But basically the way the system remains decentralized is that people can later go back and be like, hey, you lied. Actually, this person didn't authorize this trade or whatever. So it's you can kind of catch people while they're lying, or if you've heard of fraud proofs, that's basically what this is. But these what I mean by general purpose is just that they can support any smart contract. It's not that they're custom built for one solution. So this would be things like Optimism, if you've heard of that, or there are a couple other leading ones as well. But the problem there is, first of all, they're just mostly not production ready. I would say overall, from what we can tell, they're aiming to be live sometime 2021. But we're already paying hundreds of thousands of dollars in gas fees per month right now. So we have a massive incentive to kind of move to layer 2, in addition to all of these other things that we want to do, just in terms of our, the improvement in product experience. So that was a massive cost for us. And then the other issue with optimistic rollup systems is more from a product perspective. One factor with optimistic or any rollup systems, even kind of the Starkware based zero knowledge rollups that we're doing, is that the way you withdraw from these rollup systems differs, and kind of there's always going to be some delay between when the trade is finalized and when you can actually withdraw your funds after this trade if you're an exchange. And on these general purpose optimistic rollup systems, this amount of time before you can withdraw is normally on the order of a week or so. So it's okay, who's going to use an exchange where you can't withdraw your funds for a week? Probably nobody. But the main thing you can do to get around this, if you're an enterprising product company, is that you can basically offer to have some central entity like front withdrawals, where it's basically okay, I'm a user of, say, dYdX on optimistic rollups in theory. What we could do as dYdX is we could basically say, okay, we know that your withdrawal from this optimistic rollup system isn't going to process for a week, but we'll just give you the money now. We know how the system works. We know it's going to process in a week, and we know we'll get paid back in a week or so. So you can do that. But the issue with that is you have to have enough capital on hand to front all of your withdrawals for your entire exchange for a week. And that's even for us right now, that's millions and millions and millions of dollars. Imagine if our goal is to grow much bigger. So imagine if you're Binance or something like that. How the heck is Binance or anybody going to front enough capital to do all the withdrawals for the exchange for an entire week?
And then when a dispute does actually happen.
Yeah, and then disputes happen, and then you're oh my God, this is very complicated at least.
Not exactly the core business.
Exactly. So that was the main problem there. And then the last thing that we considered, which I'll touch on really quickly, was like other blockchains. So this would be things like a Solana or like a Polkadot or like things like that. Say like, you know, a lot of them also aren't necessarily production ready. Like some are kind of getting there. So that was kind of the main problem there. And then even for the ones that kind of are up and running in production right now, it's just like there's a lot of things that you have to build, like besides just the base blockchain that go into, say, like running an efficient decentralized exchange. There's like the price oracles and the wallets that you need to integrate with, and like all the other smart contract tooling to help you develop smart contracts, like a bunch of other stuff that just kind of is a little bit more behind the scenes, but that is actually really important in addition to just the base blockchain stuff. And all of that's already been built up on Ethereum for the past couple of years. And that's why it's just been really difficult to this point for any other blockchain, smart contract blockchain, to really compete with Ethereum. So kind of the way our Starkware rollups are going to work is that we kind of have this whole like other like Starkware like rollup system, but then it basically settles on Ethereum still. So we still get like all of the benefits of like being like on Ethereum. Like there are a bunch of assets on Ethereum, like all the ERC20 tokens that people like to trade, all the wallets that they like to use. All of these things will still work with dYdX because we're just like settling on the base Ethereum chain, and that wouldn't so much be the case if we say like move to another blockchain or something.
Right, right, and that was actually going to be one of my one of the things I was wondering is that, so one of the reasons why Ethereum has gotten such a head start in you know, in DeFi is the ecosystem that lives there and the composability between the this ecosystem, this kind of the financial Lego block analogy. And what is that? How does like the using a level 2 solution like Starkware sort of impact your composability?
Yeah, it's a good question. So I'd say it is a bit of a trade-off with composability. Like it's a lot easier to make composability happen if you're on layer 1 like everybody else. It doesn't make it impossible.
Sure.
Some of the things you can still do, or you can basically like tokenize your products, is kind of the main way that we're thinking about doing it right now. We're probably not going to come out of the gates with this like immediately, but I think this may be in the long-term cards for us. Say you could have like a perpetual contract that's like tokenized as like an ERC20 contract on like layer 1 or things like that. Or maybe you have governance on layer 1 and that can still interact with like all of the smart contracts that are still on the layer 2 system, stuff like that. So I'd say those are kind of the biggest ways that we're thinking about doing it. There is a bit of a trade-off, like I said, with kind of composability. I guess just the most important thing to us is always just making sure the product experience on dYdX is top class, and that's the thing we always prioritize above everything else. So we did trade off like a little bit in terms of composability here. We've basically already done that though. The thing that makes it a lot tougher with composability actually, it's not so much the like Starkware layer 2 system. It's more the like hybrid like central matching that we have. It just basically makes it such that like smart contracts can't easily integrate with like our liquidity that we have, or we can't like integrate like as easily with the liquidity that other smart contracts have. And that's kind of a trade-off that we've made to just get like a lot more performance trading system.
But does right, and I guess like you know, in your case, like you know, there's always a trade-off, and there's essentially like cost benefit analysis involved, right? And if you're talking about 100x improvement as the benefit, and you know the cost is losing some elements of composability, then I think you know the benefits definitely outweigh the costs. So you've mentioned that you guys are running the like the matching engine and the order books in a centralized manner. That will it does when they move to Starkware, does that mean that they will be decentralized or it'll still be centralized? I was just a bit
they'll still
there.
be centralized in basically the same way they are now, at least to start.
Okay, got it. Another question which I had is, like I mentioned earlier as well, that like I've now spoken to quite a lot of projects and protocols that are, and you know, no one denies that the Ethereum sort of situation is it's terrible, and it's you know customers are pissed, and you know it's kind of borderline defeating the business case, but at the same time, like just no one actually the only 2 projects that have actually confirmed that they are actively building on and you know and are will soon be launching something is you and Synthetics, who's building on Optimism. Why? I'm just confused. I'm not a developer. I'm just confused that, you know, if this is such a big problem, why do you think are so many people still in this like R&D phase? Is it like you mentioned that a lot of these like solutions are not really production ready? Is it that, or is it just that it seems to be a very complex problem as well to solve?
Yeah, that's a great question. I would say it's both of those things basically. Like it's really hard actually. You know, we're partnering with Starkware. They have like a ton of expertise, but it's kind of taking like most of Starkware's engineering team and then all of our engineering team to build this out. And at least I like to think we have one of the best engineering teams, especially in the DeFi space. But it's just a lot harder engineering wise to build that than it is to say build like, you know, the next like automated market maker or something else like that. Not to take anything away from those projects, because I think like the most important thing is just being able to like find product market fit, and certainly like Uniswap and like all those other things have been able to do that. But it's just a very hard engineering problem to like port that to like a layer 2 system. And then, yeah, I'd say just the second thing is that, you know, all of these like research based, like most of these things except for Starkware, pretty much all of them, maybe except for like a few other like layer 1 blockchains, there's still like some pretty big like unsolved research questions. And like research questions are different than like engineering problems. Like engineering problems, it's like, okay, like there's a problem, but we like basically have the tools to be able to solve it. Research is like, okay, there's this unsolved problem, maybe it's solvable. Let's like spend some time thinking about it and like trying to solve it. Maybe it's not even solvable. Or if it is, maybe it'll take us a while to figure it out. And it's just kind of like, that's what we've seen for the past like couple years. You know, this, you know, spills over into like ETH 2.0 or like, you know, Optimism or even Starkware, though they've done a really good job on it. There's just like really hard like research questions that have to be solved before you can even start like the engineering. And then even after you solve those like research questions, it's just like, you know, a really difficult engineering build out to be able to build these systems. So I'd say those are kind of the two biggest things right now. It's just like, I think especially like a lot of these DeFi platforms, I guess maybe actually the last thing I would point to is that a lot of these like DeFi platforms from a company perspective or like an entity perspective are set up to be, you know, just that, like decentralized. And I think it's just a little bit more challenging to, you know, orchestrate like a decentralized, or call it just like a looser organization around like a specific like engineering goal than it is like if you're able to just build like a, you know, more traditional company that's kind of has like, you know, more traditional, you know, engineering team and everything like that. And that's really what we have at dYdX. Like we're just like a normal company. And we have kind of some of these, like I was saying, centralized aspects of the platform. And we have some of these like open source, like decentralized aspects. But we do have kind of this like, you know, high powered engineering team that we can throw at like solving a lot of these problems. And it's sometimes like a little bit more difficult to say if you have like a community run project to just organize like the entire community around this really challenging goal of like being able to move to layer 2.
Right. That's a really good overview. As there, you know, I'm sure as you mentioned as well, you've looked at a number of level 2 solutions. Has there been any kind of like common pitfalls that you sort of like saw among these? Because like from our, like we do quite a bit of research around like level 2s as well. Obviously, as a centralized exchange, we don't really need to use one, but we've been just researching them to kind of to produce content. And one of the kind of strange parts which we've noticed that is common across multiple of them is that like so many of them have a token for a sort of, you know, for something that just really does not need a token. And it's sort of, and there's been a number of them that we look at and this could be really great if it didn't have a token. Has there been any have you seen these kinds of I guess pitfalls among the level 2s?
Yeah, it's a good question. I would say like among the ones we considered, like the ones we most seriously considered were Optimism and then Starkware, obviously. Like neither of those have a token right now, at least. So I didn't see that as kind of a big problem for the ones we were at least mostly considering. Again, like if we were to switch to like another layer 1, we would have had to consider that. Like say we switch to like Solana or something, like how are users going to get like, you know, whatever the Solana token is to be able to pay their fees or whatever. So that would have been a problem. I would say it's not necessarily the biggest problem though. Like I think if there were something that was able to offer like the best product experience for like a scalability product, we still would have used it even if it had a token. But it just like, I think we've kind of, hopefully, we've mostly learned our lesson from like 2017, that just like, product or protocols that kind of come out with these useless tokens don't do so well in the long term. That's one of the reasons why we've been really thoughtful about like, how we approach having a token at dYdX. We still don't have one actually 3 years later. And that's just really because we're really laser focused on the product experience and just like nailing that before we can kind of come in and insert or, add a token after that.
This is actually perfect layup to my next question. So dYdX is, I think it's the most known and trustworthy decentralized like margin trading protocol, and you guys do not have a token. Uniswap most recently, launched their token with a sort of with tremendous success. What are your thoughts on a token?
Yeah, good question. I set myself up for that one. Yeah, no, definitely we are obviously looking at all the things that are happening in the decentralized exchange space, like all of the, orders of magnitude growth that's happening with these platforms that have done successful token launches, and we're taking notice. I think all of these things that, a lot of these other platforms that have, started with products and then added a token on later, like a compound and then the comp token, or like a Uniswap and then like the Uniswap token, I think have just been like a really good example for the things that we can, mimic likely at dYdX. So I think we're probably pretty likely to launch a token on like a shorter time horizon. We're still thinking through it. Again, like our top priority always is just to make sure that the product experience is the best it can possibly be on dYdX. So we definitely don't want to, come out with the gates with like a useless or especially like a, product degrading token or something like that. But I think with a lot of the liquidity mining stuff that's been going on, we've seen how these tokens can really be additive to the platform overall. And it's like, well, we're dYdX, or like an exchange, we want to grow. So it's like all of the liquidity mining stuff, if we channel that towards just incentivizing the right behaviors on dYdX, I think could be really valuable for us as well. It's like, again, very much like a compound, like we're a decentralized exchange, our admin keys are still just held by like a multi-sig. We want to decentralize governance of the platform overall. We want the community to have more say and say like what assets could be listed on dYdX. A lot of other, metrics or aspects of the protocol that can be controlled. So I think it's just like in a very similar way, like a token could be really useful for just, channeling a lot of the successful behaviors that we've seen. Kind of a token be able to organize a community around to dYdX as well. So we're definitely taking notice. We're thinking really seriously about it actually. And it's definitely something that we may do on, a shorter time horizon, no commitments at all. It's again, like we're still thinking through it. And our number one priority right now is to just still the Starkware build out, because that's like the most impactful thing for the product. But it does seem like if we were to do a token, in say call it like the medium term, like even the next like year or two, just with all the excitement that's going on around DeFi, now might be nowish, like maybe a good time to do it. So we're thinking pretty seriously about it.
Got it. Yeah, definitely looking forward to that. I know you're super busy, and so before we wrap this up here, I got a couple of quick questions I'd love to get your take on. So today, arguably like 99% or 100, almost 100% of DeFi exists on layer 1 Ethereum. If we look 1 year ahead, what would you kind of forecast this number to be relative to layer 2 stuff, Ethereum and other chains? How do you think that'll change? What would this percentage be?
It's a good question. A year from now? Well, definitely us. So that's a given at least. I'd say probably Optimism will be able to like launch in production by then, which I think will bring a lot of like, that's what you were saying, like synthetics and a bunch of other things I think may move to that if they're able to launch in the next year. Like I would imagine like a Uniswap would probably move to that, maybe even a compound or something. So yeah, it's tough to tell. I don't know. I think it's like if somebody were to come out with like a really good general purpose like scalability solution, which general purpose again just means you can like deploy any smart contract that you have on Ethereum like onto this layer 2 solution. Probably a lot of stuff would move to it. I think one thing that's kind of the space has to be careful with, or at least that people have to be cognizant of, is just like fragmentation across a lot of these different like layer 2 solutions. I think we'll see just like a period of where like while just a lot of the new solutions are pretty nascent and none of them have really built up like big network effects or anything like that, we'll just see a lot of like splintering off to like a bunch of different things. Yeah, I don't know if I had to answer like what % of like major DeFi protocols will be on layer 2 a year from now. I'd say like 50%.
Wow. Okay. And oh, got it. Okay. Next one is do you think ETH 2.0 staking will come out this year? Yes or no?
Oh man, no, definitely not in 2020. Also, I'm like so negative on like ETH 2.0 in general. I think the project is awesome, but it's just like the way they're approaching building it is just going to take a really, really long time. I really don't think that smart contracts are going to see any benefits from ETH 2.0 within the next 3 years, though I hope I'm wrong.
Yeah, I think it comes back to what you said around like different ways of kind of building and running an organization. Like if it's so incredibly decentralized and community and kind of consensus driven, then you are kind of trading off a lot of speed.
Yeah, I completely
my
agree.
last question to you is, if you had to describe DeFi in one word, what would it be? What does it mean to you?
One word, huh?
Take your time.
Yeah, I'm probably open, maybe community. Yeah, something like that.
Nice. All right. Thank you so much for this talk, Antonio Juliano from dYdX. This has been very exciting.
Yeah, thanks so much for having me. Really appreciate it.